Hello, chart watchers, and welcome to this Wednesday, September 19th Market Watchers live show with your hosts, Tom and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Got another great show in store for you. You can see here we've got the Dow Jones Industrial Average currently up nearly 200 points, 26,442, about 170 points away from an all-time high. So we'll be keeping an eye closely on the Dow Jones. The S&P 500 also up about 6 points today, getting closer to that late August high, which represents its all-time high near 2917. The NASDAQ down 10 points today, obviously underperforming on a relative basis, as are the small caps. The Russell 2000 down about 1 point today. 10-year Treasury yield on the rise, continuing to move higher, 3.08% after making the breakout yesterday, closing at 305. That multi-year high now at 3.11% is clearly in focus. Volatility, you can see dropping, potentially closing at the lowest level we've seen in the past several weeks. So volatility, not a problem for the market right now. Materials making a breakout above recent highs. This has been a group that really hasn't performed very well in 2018. So it is nice to see a breakout here. We'll see whether or not it can confirm. But materials having a strong day. Financials leading the rally today. Huge move to the upside. This is not surprising given the action we've seen in the Treasury market with all the selling there and the rising Treasury yields. Financials tend to outperform. So I think this is very timely. Life insurance, talked about this quite a bit yesterday. 800 has been a really difficult area to close above. You can see we are making a big breakout on life insurance with the rising Treasury yields. Banks also coming back to life with the rising yields. And then finally, we've got a couple of cannabis stocks here. Cannabis stocks have been in the news quite a bit of late. Tilray up about 50% today, and New Age Beverage 46%, headlining a list of these cannabis stocks that are doing very well. We'll talk about this in just a bit. But it is hump day, Erin, and I don't know, the market just doesn't seem to want to die off here. It just continues to threaten new records. What are you seeing?
Yep, I agree. But I'm watching those short-term indicators of mine, those Swinland trading oscillators, and they're starting to finally get overbought. So I am not thinking this is going to last much longer. I think we're due for at least a pullback. So we'll have to see whether that comes to pass or not.
Yeah, and I've got a lot of mixed signals. I mean, historically, and I follow the historical tendencies in the market quite a bit. And it's not my number one go-to. Obviously, I follow technicals more than anything. But it is noteworthy that the second half of September tends to be extremely weak. Also, I posted in my blog this morning, the 19th of the month carries extremely bearish tendencies since 1950 on the S&P 500. It's got a annualized return. I'm not just talking about September 19th, but the 19th of every month has an annualized return of minus 32% going back almost 7 decades. And I think a lot of that is the timing of the month being close to option expiration, which is the third Friday of the month.
Mm-hmm.
But the market seems to be ignoring all of these historical tendencies, and we're seeing mostly movement to the upside, although a little bit of relative weakness in the NASDAQ and Russell. But we'll get into all that in just a bit. We do have a special guest with us today, Dave Keller. Dave, welcome to the show. I know you have got an exciting announcement today, so I'm going to let you share the stage and go through what you're going to be talking about today.
Appreciate it, Tom. Erin, good to be on with you guys again after a little break. Yeah, very excited to have been working with stock charts for a little while now, and super excited to announce I'll be launching a blog called The Mindful Investor today, and basically build on a lot of the discussion that I led at ChartCon, which was the mindless investor versus the mindful investor, and talking about having a healthy relationship to past, present, and future, and different ways to use charts to minimize the impact of behavioral biases. So in the blog, I hope to explore some of those themes over time, which should be really cool. A lot of really good content to go through. And then today, yeah, we're gonna pick one bias in particular called recency bias, which is something that creeps up a lot of times, where you sort of expect that things will continue ad infinitum, and a lot of times, as we know, if you've traded for a little while, that tends to work until it doesn't. So we'll talk about some ways to minimize the impact of that and hopefully make some healthy decisions.
Awesome. I know, of course, I was there at ChartCon, and it was an absolutely excellent presentation that you gave. So I'm really excited for our listeners to tune in and hear some of what you are going to be talking about later. I will tell you that I am a mindful investor as long as I'm making money, and I tend to be a mindless investor when I'm moving.
I guess that's a good way to look at it, I suppose.
Yeah, well, we're looking forward to your discussion in a little bit, Dave. We'll bring you back probably in about 15 minutes or so.
All right, let's look at the upcoming schedule. Julius DeKempener is going to be with us tomorrow to talk RRG. We are happy to announce Mary Ellen McGonigal will be here with us Friday. And Tom, you've got a workshop coming up next Tuesday, or this Tuesday, I suppose I should say. Hopefully you're thinking about that. Today's agenda, however, David Keller, as we just introduced, will be here for the Mindful Investor segment. 10 and 10 to 1. Our first stock will be Fitbit, FIT. And finally, we're going to finish off with Are You Buying This? You'll want to stick around for that very interesting segment. But let's go ahead and get started with some technical news. I know you alluded to some very interesting stuff there, Tom. What else do you have?
Well, the 10-year Treasury yield is the interesting part. I mean, you can see this is a long-term chart. Well, I say long-term, longer than what I normally show here on Market Watchers Live. But you can see we bottomed back in July of 2016, and we have been trending higher. This is the longest stretch of movement to the upside in the 10-year Treasury yield in quite some time. And we're talking about possibly breaking out to a new high. And I can stretch this chart out, but you'll see that it has been several years since we have seen a move in the 10-year Treasury yield above this 310 level, 311, which is what the high was back in May. This goes back into 2011. This is a 7-year chart right here. And you can see we have not been above in that period. So let's go all the way back to the start of the bull market and take a look. And you can see that we have not been above this level since back in the middle of 2011. So it has been over 7 years. And it seems like there's more and more money rotating away from the Treasury market and into the stock market. And we've had a huge run up the past couple of years with Treasury yields rising. And that tends to be the case because you've got a lot of folks trying to decide where they want to put their money. Do they want to put it into bonds? Do they want to put it into stocks? So you've got not only new money coming into the market, but then you've also got allocation money that rotates back and forth. And so when you're all-time lows or near all-time lows, actually we were at all-time lows back in July of 2016, but we're still fairly close. And as these yields move up, it's telling us the money rotating out of treasuries has to go somewhere. And if it's a strength in the economy, likely that money is going to find its way into the stock market. So I'm watching this 311 area very closely. I think we're going to break out. I think we're just simply consolidating, have been consolidating before we get another push to the upside. This morning, we got August housing starts out, 1,282,000 units, which was better than expected. The consensus estimate was 1,240,000 units, so a slight beat there. Building permits did come in a little bit lower than expected for August, 1,229,000 units versus 1,315,000 units. But I do like to point out building permits are not required to be disclosed in all parts of the country. So I always take building permits with a grain of salt. I think the housing starts number is more important. We are seeing a move up in housing starts relative to what was expected. However, the more important thing is what's going on the chart. And when we take a look at the home construction index, there is still just no life here. So even today, earlier, we were up higher, trying to get back through the 20-day moving average. I'm not even sure the 20-day moving average really means that much right now because that's more of a trend following kind of a moving average. And you can see we're just constantly up, down, directionless. If we pull up a little bit longer chart, we go back on the weekly chart, you'll see, if anything, we've got a downtrend that continues in play. And here you can see the trend following beneath that 20-week moving average. So it's going to be difficult for me to get too excited about home construction until we at least can get a weekly close above that 20-week moving average. That has been difficult throughout most of 2018, and I would be waiting for that before I would get more excited. Now, a couple of areas that have been performing well, certainly over the past few months. Let's take a look at the footwear group. This is in consumer discretionary. Big breakout yesterday. Mentioned this one in my blog. We had an uptrend in play. Nice little cup, handle to the side, and then a breakout yesterday. I think footwear continues to look very strong. The computer hardware space, this, of course, houses Apple and some of those stocks, but you can see the breakout that was made in late August above about the 29.50 level. We're consolidating. You can see the PPO has been moving back down toward the center line as we consolidate. I would not be surprised to see another push to the upside in this group as we head into earnings season. We do tend to see money rotate into Apple and some of the other stocks in this space as we approach earnings season. So wouldn't be a shocker there. In the transportation area, railroads. Railroads have been on fire. Good news out of Union Pacific yesterday announcing a strategic plan there. That certainly gave this group a lift. They continue to perform well. I mean, you can see just going back the last 6 months how the group has risen from 1750 back in April to 2300. That's almost a third, probably about 30% in 5 months. Huge move. Obviously, we could probably use a little bit of pullback here and consolidate for a bit, but railroads have been incredibly strong. Another part of the transportation group, airlines. You can see that airlines, after struggling for quite a while, continue to trend. And this is a good example of exactly what the 20-day moving average will do for you when you're in an uptrend. We continue to bounce off of it. The one problem I do see here is we're trying to make a breakout, and we've got one currently with a negative divergence. So watch for a possible reversal on airlines. If we do see that reversing candle or a false breakout, if we get a big reversal later today or maybe later this week, that could signal a short-term top on the airline group. Let's pull up. We're going to move over to materials. Of course, I mentioned materials at the open of the show, doing very well today, breaking out. One of the reasons, specialty chemicals continuing to perform well. Beautiful move to the upside here. A lot of volume coming in. I think this is a group that looks really solid. And, of course, I do want to mention the life insurance and banks, because the financials should do well in a rising interest rate environment. Life insurance and banks in particular tend to have a very strong positive correlation with the direction of the 10-year Treasury yield. So we are bouncing here. You can see life insurance had a nice move back in July. The PPO went positive. We got a center line test, and we're just starting to turn up with a breakout. I think life insurance looks really good here with the rising rates in place. And then you've got the banks, which don't look nearly as good as life insurance, but we are trying to get back up above both moving averages. So if you're trading the banks or looking to trade the banks, I would watch this 20-day moving average. If we can continue to strengthen, get back up close to that 495 level, what we could have is off of an uptrend, a inverse left shoulder, a neckline, back down to a lower low to put in an inverse head. This could be a move up to 495 to establish the right side of the neckline. Possible pullback to maybe that rising 20-day, something to look for. Okay, I mentioned at the top of the show, Tilray. Okay, so they announced that the DEA has approved the company's request to import capsules of CBD and THC into the U.S. to be used for research at the University of California, San Diego. The reason it's being imported is to study essential tremor, which is a neurological condition that causes uncontrollable shaking in the elderly. The estimate that I saw is that about 4.6% to maybe 6.3% of adults over 65 suffer from this condition. And the CBD is looked at as a much safer alternative to treat this. And of course, Tilray CEO was also on Mad Money last night. So let's pull up this chart. I mean, you want to take a look at a stock that is heading in parabolic fashion. This is the one. Tilray, $22, $23 back at the beginning of August. It is now $233, and it's up 50% just today. But look at the volatility. It opened almost right where we're sitting right now, within 22 cents of where we opened, $233. But the low today is 175. So if you jumped in on the news this morning, you had to weather a 25% intraday drop to hold on to get back up to where you were at the beginning of the day. So these stocks are incredibly volatile. One other one that I'll mention here is New Age Beverage, NBEV. Look at this move here from $1.60 3 days ago, actually at Friday's close, to over $4 today. And look at the volume coming in. There is a ton of interest in these cannabis stocks. No doubt about it. It's an exciting group, but Tilray is now trading at 500 times revenues, not earnings, 500 times revenues. Now, many of these companies likely will do very well over time, but just understand if you're getting into these, you have to be prepared for some wild swings in both directions. And I think, Erin, you would probably agree. Some of these stocks are looking rather parabolic to me at this point.
Oh, absolutely. Like you said, the Tilray is a study in a parabolic.
And we've had, we've seen these, the dot-com bubbles, or bubble back in, people probably don't remember this, maybe some of you didn't trade back then. The NASDAQ in 18 months almost quadrupled. The entire index, that was a bubble of mass proportions with the dot-com era and all. And then, of course, we had Bitcoin recently that went straight up and has come back down quite a bit. You have to be careful with these parabolic moves. But I know you've got a few upgrades and downgrades. What are those looking like?
Let's take a peek. All righty. So I'm going to start off with the downgrades, actually. I was looking at these closely. All right. So for KBR, Macquarie downgraded it from outperform to neutral. I don't like this chart at all. I think you could make a case for a head and shoulders, and it looks like we're dipping down to execute and confirm that particular pattern. So I would be very careful of that and notice that, this top came in right at the top from back in January, and it is faded all the way back down to this area of support, and now it is struggling to hold it. If this does continue lower, I would look for a move down to this support level here at these tops that we had back in April. So, and if you look back here, there's a really nice looking ascending wedge or ascending triangle. And again, you got the breakout. The expectation was a move about this of this height. And wow, that took us almost exactly there. So sometimes these patterns do end up coming through like they're supposed to in the textbook. Not always, but this one I would have expected to see a breakout. Once we got that breakout and then held that support, it's not a surprise at that point to see it continue higher. But right now on this downgrade, I don't like it. Let's see, LYB. And this one was downgraded by JP Morgan from neutral to underweight. I guess better late than never. This one has been in a serious decline for quite some time. The PMO had picked it up at the beginning of September, and the trend model, the intermediate term trend model, which does come in usually a little bit later in the game, gave us a neutral signal back a couple weeks ago. So I guess, it's to the point now they did finally downgrade it, but I would expect a move to test these lows back here from April and late October. So I don't think this one's looking good. Maybe you want to short that. I don't know. All right. E-Trade was upgraded today by Jefferies. It went from a hold to a buy. I like it. I can see why they might have upgraded it here. Of course, on the upgrade is when we got that big move to the upside, but we'd already started to consolidate right here on some important support. And now it's turning back up. The PMO is turning back up. So this one's looking pretty good. And on the upgrade, I would look for it to at least come up here and test that resistance level at about $58. Juniper Networks was also upgraded by Nomura from a neutral to a buy. And you can see it's really enjoying that upgrade move. We've got a PMO buy signal that came in. This looks very much like a breakaway gap. I wouldn't be looking at this as an island getting ready to form. That's a pretty strong move off of a really nice rally that we'd already seen on Juniper Networks. So I would expect to see more upside. You can see right here too with the OBV, it's getting near those tops we had before. And if we get the breakout above, I would be looking, like I said, to continue this move to the upside. And finally, SunPower was upgraded today by Credit Suisse from a neutral to an outperform. This one had already made its move yesterday. So I would say this one is, the chasing the stock situation. you know, I think there's still more to go here. That was a nice breakout move yesterday, and we are getting a continuation on that upside move. But I can see some resistance where we might see a bit of a pullback here at about 825. I would probably put this on my watch list and see if we can't get a little bit more of a pullback before I would chase this stock. I think that it's already made a lot of its move and it's getting ready to hit some important resistance. So be aware of that. And that concludes the upgrades and downgrades. And I would say it's time to bring David Keller back on. Welcome back to the show here. Yeah, it has been a while, David. So I'm excited to talk to you again. I really enjoyed your ChartCom presentation. I know I told you that there, and I will reiterate it. I very much like the way you do your research and you know, the mindfulness of stock investing. I think it's important.
Thanks so much. Yeah, it's the things I talked about at ChartCon and the things that I hope to cover in my blog really focus on the lessons that I've learned just on the institutional side of the market during my career, which is there's so many things that get in the way of our good decisions and force us to make bad decisions. And you know, the first step is sort of an awareness of it, and then the second step is actually doing something about it, which is probably the toughest part. But yeah, so thanks so much for having me on, you guys. I enjoy Market Watchers Live. I watch it when I can, and I appreciate what you guys do. I think it's a great way to look at the markets. And with my time with you today, I'd like to talk about what I would call resisting recency bias. So last time I was on, which was a couple months ago, we talked about herding, which is you know, when people pile into one side of a trade or another. And you know, again, there are times when that is really valuable to find because there's an investable opportunity there a lot of times. Recency bias is one of those things that if you've ever heard the quote, "Past performance does not guarantee future results," which is a disclaimer on most any investment thing you will ever read, that plays to recency bias, which is the fact that we tend to assume that whatever is happening or whatever has been happening recently will continue to happen. Now, that is different from trend following and momentum investing. And what I hope to do today is just explain what those differences are and what recency bias is, and hopefully get some clarity about how you can recognize it and combat it. You know, the blog that I mentioned, I'm excited to start writing for stockcharts.com is called The Mindful Investor. And at my ChartCom presentation, I compared this paradigm of the mindless investor to the mindful investor. So I'd love to just spend a couple minutes explaining these two and then go from there. So many of us fall into the trap of mindless living, and when it comes to investing, mindless investing. So, you know, mindfulness, in my opinion, is not just being aware of, you know, being mindful of what's going on around you, but it's understanding your relationship to the different time frames. So what has happened before this moment, what is happening at this moment, and what could be happening next. And I found that in life, just like we become fixated on the past through some, you know, challenging life experience, or we get focused on the future and you know, and way too anxious about something that might happen or could happen. You know, what happens is we ignore what's going on around us. And as investors, that presents plenty of challenges as well. So what a mindless investor does, which I think you will probably find snippets of this in your own investing, and hopefully we can work together over time to minimize that. But we tend to ignore the past. So we focus on what's going to happen next. We focused on the next home run, the next big idea, and something that didn't go well, we just kind of push that aside mentally. We worry about the present. So instead of looking around with opportunistic perspective, we worry about what's going on. You know, the movements in the market, the volatility generate fear, which causes us to make bad decisions. And finally, we are fearful about the future. That anxiety about what could happen and all these potential future paths causes us anxiety. And as a result, you make bad decisions now based on something that may or may not happen. So, and one other comment on this, you'll notice that there's sort of a linear relationship to the time, right? So the past is what happened before us, the future is what's coming next, and there we are in the middle at the present, and we think of it in a linear relationship. What a mindful investor is hopefully able to do is have a much healthier relationship at one time with all of those different time periods. So any of you that have experimented with mindfulness meditation or any sort of mindful training, you'll know that it's a lot about the now. It's a lot about having a heightened sensation of what's happening around you. Because if we get too focused on the past or the future, we forget to, stop and smell the roses, to look at what's happening, to use all of our senses. And as investors, that is what tends to happen as well. So what a mindful investor does is able to learn from the past. So instead of forgetting and ignoring what had happened, you learn from it. So things that might fit into that category would be things like a trading journal that, Gaddis Rose and Grayson Rose talk very well about in some of their presentations. It's doing things like reviewing a bad trade that you've made or reviewing a good trade that you've made and trying to understand, get inside your mindset, what caused you to make that good decision or that poor decision, and how can you adjust your plan going forward. Also, you plan for the future. So instead of worrying about what could happen next or worry about what trade might go against you, you have a game plan. So you have a trading plan that is well articulated. You have a sense, you have lines in the sand that when a market moves against you or when a trade moves against you, you agree to revisit it. And so you don't have to worry about what might happen because you have a plan in place that's going to help you minimize the negative impact. And finally, maybe most important, you live in the now. You don't worry so much about the past and worry so much about the future. You're aware of what's happening now. And my research firm called Sierra Alpha Research comes from aviation, and Sierra Alpha is slang for situational awareness, which is essentially a pilot's term for recognizing your surroundings and being aware of it. So when you're flying an airplane, you need to be looking out the window and you need to, or out the cockpit, and you need to be aware of other planes that might be on a collision course. You have to be aware of a mountain that's in front of you. You have to be aware of where you might land in case of emergency. But you also have to be aware of your instruments and understand the condition of the plane and fuel and all of that. And a lot of bad decision making as a pilot comes from not having an awareness and making a decision that's not based on having all the information in front of you. So what's good is those of you on the show today or watching have access to stockcharts.com, which has plenty of really effective tools to give you an awareness of what's happening around you. And that's everything from just having good charts to understand how an individual stock or group or sector is moving. It's also things like a relative rotation graph, screening tools to allow you to look at the entire universe of interest and focus in on what should be most important. So there's a poll that we have going right now that I'd love those of you on would take a few moments and think about. You probably do well with one or two of these. You probably do well with the present, with your current toolkit. Or you may have a good plan for the future, a good trading plan, or you might keep a trading journal, do well. But I bet there's one or two of those that you probably do not do well, that you could focus more of your attention on. And I'd be very interested to know, and maybe we'll visit the results at the end of our discussion. Which one of these are you struggling with? Which one of these do you find you do not pay as much attention to? And then over time, hopefully we'll help you address each one of these and ramp up your capabilities with it. So the one bias that, again, what causes bad relationships with these timeframes? A lot of times it's behavioral biases that are hardwired into our brain. There's certain things that we do as humans, which come from, human beings evolving over many years. And again, some of these things helped you when you were running away from a tiger or trying to find something to eat, but unfortunately does not map very well to good investment decision making. So there's a lot of things that we just need to be aware of and hopefully find some techniques to help minimize the impact of these on our decisions. So recency bias is a commonly followed technique, which essentially is our assumption that whatever has happened recently will continue to happen. And it's very timely right now in the US markets because so many stocks like an Amazon feel like they've been in an uptrend forever, right? They've continued to go higher highs, higher lows, upward sloping moving averages. Amazon has been a consistent outperformer. So the assumption, without knowing anything else, is of course this is just going to continue higher forever, right? Because that's what stocks should do. Now, as we know, those of you that have been trading for many years or many cycles will know that that's not the case. It is the case until it's not anymore, right? So things continue in one direction until the trend is over. It's the end of the trend. And understanding when that is happening, having some sense of what you would need to see for you to make a change in your position or your outlook, and then just having some sort of checks and balances to make sure that you're aware of when trends are changing. That's what really helps you minimize recency bias, because on its own, it's okay. There is an inertia to trends, and stocks, going up will tend to continue higher. Stocks going down will continue to go lower. But without a toolkit to help you identify when that's ending, is where you end up holding onto a position much longer than probably beneficial for you. Now, we make these assumptions not just with analyzing individual stocks, but we make these with many investment decisions. And there's a reason why anything you read that talks about performance of an investment vehicle will always have some sort of disclaimer of past performance does not guarantee future results, or something with similar language. Now, you see it a lot of times with mutual funds. So, probably one of the most painful things you can do is look at mutual funds that have done well over like a 5-year period and bet on them to do well over the next 5 years. Because if you look at the data, it actually tends not to work. In general, you're better off looking at the funds that have been underperforming over the last 5 years, because those are what tend to do well. And that's based on the natural cycle in the market, that certain investment themes will work, and then at some point they will not because of the changing conditions. So, we have the ability on stock charts to do some really good screens on mutual funds, on ETFs, on stocks making new highs, making new lows in different conditions. But again, in general, looking at fund performance over that sort of time frame and then betting on it to continue just because that's what's happened so far doesn't tend to be an effective investment approach. So how do we try to combat this recency bias, this assumption that things will continue perpetually? Well, there's sort of two ways to think about it, and it gets to the different types of technical approaches. So if we think of the difference between leading indicators and lagging indicators, that's what's going to help us sort of come up with a good list to start with. So leading indicators, I would think of it as anticipating the trend. These are tools that are going to help you anticipate what's coming next. These are things that are going to try to get ahead of an inflection point. It's going to tell you something's happening before it happens. And I think of these as sort of red flag indicators. When one of these triggers, I put it on a watch list, I put it in a chart list, and then I make sure that I follow what's happened after. So some common things that might fit into this category, I would consider support and resistance levels as one of those. So if there's a certain high, right, a stock hits a high that where it has hit resistance before, we might anticipate that there will be resistance again. And that's the technical analysis 101 of using support and resistance levels. It's thinking that there are levels in a market that are meaningful. So with the chart of Starbucks that you see on the slide here, it pulled down to around 55 or so a number of times. That's a support level that we might anticipate it's going to continue to find support at. Finally, we gap down, and then we have to reevaluate. Okay, now that we're at new lows, how do we think of support and resistance? But in general, there's value in looking at where a stock has turned previously. Second leading indicator I think of would be oscillators, and RSI is a common one that I use regularly, which is just trying to measure the momentum behind a stock move. So when a stock or a sector or an ETF becomes overbought or oversold, that on its own does not tell you that the trend is over. It just tells you that it's gone in one direction a long time, and longer than it tends to for that specific instrument. So it's not telling you that the market is absolutely going to reverse, but it should put it on a watch list, on a red flag list, just to be aware of a potential reversal. You want to see the reversal in the price itself. So that gets us to the lagging indicator side. These are things that are not meant to anticipate the trend, but more to follow the trend. And there are most of the technical toolkit, especially on the institutional side where I've spent a lot of my career, is in trend following. So you're not trying to pick the top or the bottom. You're trying to follow the trends after they've emerged, because there's a lot of money to be made on the trends as they play out, and as people buy into an investment idea over time and cause the persistence of trends. So common things that might fit into that category, one would be Dow theory, which is just the idea that an uptrend is higher highs and higher lows, a downtrend is lower lows and lower highs. So just by looking at the peaks and the valleys in the price of an instrument, you can make a very simplistic assumption of what the trend is. And when I teach technical analysis, the very first thing that I've always had my students do is answer the question, is this stock in an uptrend or a downtrend? Because until you've clarified that, there is nothing else that you really want to talk about, because that is the simplistic, basic building block of price movements. So in this chart of Starbucks, we can see a clear uptrend from the low in July after it started to rally. We see a consistent pattern of higher highs, a pattern of higher lows, and that is what defines an uptrend. That is what defines the fact that the stock at this point has been going higher. Finally, it's moving averages, or something, a derivative of moving averages. So MACD is probably a commonly used one. So any sort of moving average by definition is lagging behind the price. It's smoothing out the price movements, not necessarily jumping the gun and trying to tell the future of what's happening, but it's more to recognize and respect when the trend has reversed. And there are many trading systems and simplistic ways you can look at markets using a simple moving average crossover system, which again is not going to pick the ultimate high and low, but is going to help you be into the meat of a trend. And we'll look at some examples of each of these as we go through them. So some of the leading indicators we've talked about, let's look at each of these. And the first is looking at support and resistance. My first suggestion to you is, when you're looking at a price chart, start at the current price and then look to the left. So right now, this is a chart of Facebook from earlier this morning. At the time I took the screenshot, trading around 160. The first thing we want to do is look left on the chart to see where are we at relative to consistent support and resistance levels. Where are we at relative to levels where I think there might be a meaningful reversal? Now, in the blue dashed lines here, I've highlighted just visually where have I seen support and resistance. So 170 has been a consistent support level for Facebook. If you look back a number of times, when it's been above, it's come down, and that's served as support. And so again, if and when we come down to that level, I'm certainly going to recognize the fact that just because that has been support so many times, I want to be aware of it and potentially make a bet as a result of that. Since we've now broken below that, we're in a confirmed downtrend with Facebook of lower lows and lower highs. I have to look to the left, and I'm seeing maybe a short-term support around 156, which was the swing low before the gap higher in April. I'm also looking at the historical lows around 150, 150, 151, which is where was really the low in Facebook after the peak at the end of January. So as we go lower, I'm keying in on those levels as potential levels where I might anticipate some buying power to come in. And again, that's not saying it's going to happen, but it's a level that I want to pay attention to. And maybe I set an alert for when Facebook gets near to some of those key levels. If we would rally, that's when I start to look left and pay attention to historical resistance levels. So in this case, 195, which was resistance. This was the previous all-time high before it broke higher, and then the ultimate high before the huge gap down in July. So again, you start with where you're at now, and you look left on the chart and find the most meaningful levels to pay attention to. So again, what that's doing is it's ignoring the current trend, and it's just paying attention to price levels. What levels do you want to set on an alert, set on a spreadsheet, write on a notepad, that when the price hits that level, you promise to revisit your position or revisit your outlook. The second sort of leading indicator approach we can use is what I call watch for extremes. And this is looking at oscillators, looking at momentum indicators. And one of the common ones that I've used for years is RSI. Simplistic technique. It's a simple way of measuring price momentum, but I think the beauty is in the simplicity and the fact that it's consistent. So you can look across an entire list of stocks or a sector and sort them based on the RSI, and you will very quickly identify what's been working and what has not over a certain time frame. Healthcare is an interesting example to use right now because it has recently become what I would call extremely overbought, or an RSI above 80. So let's dig into that just a little bit at the bottom here and talk about it. So when the RSI in general tends to fluctuate, or by definition from 0 to 100, we tend to consider 30 to be oversold. So when the RSI gets below there, you'd anticipate a short rally. And when the RSI gets above 70, that's overbought, and we'd expect a short-term downside correction. But if you look at when the RSI became extremely overbought, or above 80, that tends to be, especially early on in the trend, tends to suggest a short-term correction, but a persistence or a continuation of that existing trend. And I guess the way I've thought of it behaviorally is there's so much momentum behind the stock or the ETF, you'd expect that momentum may continue even further. That did not happen here at the beginning of 2018. That was sort of the blow-off rally. So when you see this happen at the end of a move after an extended trend, you almost think the opposite. That might be one last gasp to the upside. Here, however, the XLV has been more earlier on in the trend, just recently breaking to new highs, a resumption of the uptrend, upward sloping moving averages. We see that the RSI became extremely overbought. So it suggests further upside overall over the long term. What's concerning here to me is similar, Tom, to one of the stocks you showed earlier, which is this bearish divergence of higher highs, might have been airlines if I remember right, and this downside divergence with RSI. So suggesting the momentum is lightening up on each of those uptrends. So again, depending on your approach, this may not be like a trading system. You might not say, all right, when the RSI hits 70, I'm going to sell. And I certainly wouldn't recommend doing something like that in a vacuum. But noting that something is overbought or oversold, or noting a divergence, is what puts something like XLV on my radar, on a correction watch. Just understanding this has become extended, it's gone up a lot, or it's gone in one direction, and I want to be aware, I want to get ahead of any sort of turn. And I'm looking for the price to make some sort of distributive movement, make some sort of turn that might confirm what I'm seeing in the oscillator. But at this point, it's still going up, and I have to respect the price, that the fact that the price is going higher. So to finish up, we'll talk about the lagging side of it. So we've talked about leading indicators like support and resistance and RSI. Let's talk about lagging indicators, and a couple that come to mind. One is Dow theory, which is, as I mentioned, it's the very first thing I always teach younger analysts or people just getting started with technical analysis, because you have to start with price. Is the price going up or is the price going down? And that should be the basic starting point to your analysis. So this is a chart of the S&P 500, and again, is the price in an uptrend or a downtrend? Well, by Charles Dow's definition, it's in a clear uptrend of higher highs and higher lows. And what I'm looking for on any sort of volatility, any sort of pullback, are we putting in a higher low? And what has continued to happen with the S&P, with the Dow, is that we've continued to put in a higher low. Where we've not seen this higher low is in global markets, in something like EM or frontier markets, where we've actually seen the opposite. We've seen lower lows and lower highs. So Dow theory on its own can be a good lagging indicator confirming that something has reversed. So recency bias tells us that this trend should go on forever. By watching for the highs and the lows relative to the previous swing highs and lows, we can confirm when that is no longer the case and make sure we take action as a result. Then the final thing I would say is just having something in your toolkit, some sort of trailing stop or some sort of level, some sort of indicator that's going to lag behind the price. And whether or not it is a trading signal for you, it should be something that causes you to revisit it. And I would say, even when you enter a position, you should sort of agree with yourself, write it down somewhere. At what point will I revisit this thesis and reevaluate it? So I've thrown a couple things on a long-term chart of the S&P. There's the 50 and 200-day moving averages, which again are pretty simplistic model, but just looking at any time that this hits the 50-day moving average, I'm going to revisit and just say, how does this look? Are we still making a higher high, higher low? Am I still comfortable with it? That might be one way to think of it. I also put the Ichimoku cloud, which is a Japanese traditional technique. It's an interesting indicator and sort of beyond the scope of our discussion, but it's interesting because it projects into the future about 26 periods. So in this case, it's projecting 26 days forward. But I'm basically using the price movements now to project a level of support in an uptrend and a level of resistance in a downtrend. And as the cloud looks like this, it's telling us as the price is higher, sloping higher, this is an uptrend. If and when that changes and we start to break into the cloud, or when the cloud changes and reverses, that tells you need to revisit things. So again, there are many ways, much more sophisticated, much more effective, that you can use. But these are, at the very least, some line in the sand that's going to cause you to revisit it, and something that lags behind the price, I find is a really effective confirmation tool to prevent you from staying in a trade way too long. So just to very briefly wrap up here with 3 suggestions for you. Number 1, mix the systematic with the subjective. And so for me, my toolkit has a little of both. I like this the systematic nature of a basic trend following model. So in this case, I'm looking at the 50 or the 10 and 40 week moving averages on the S&P 500. As long as these are, the 10 week is above the 40 week, by definition of moving averages, it's going higher. So If and when that changes, I'm going to revisit my thesis that the market is going higher. But at this point, there's no reason to suggest it. And then once that happens, you want to mix in the subjective. I would not consider this to be a standalone trading system, but it is something that's going to cause me to go into the sectors and the stocks that make up this index and make some decisions as a result of it. The second thing is always look for what is different, and this will help you fight recency bias. So if the market has been going up, which in the US, there's no denying it has been, I always like, instead of looking at the new highs list, I like to look at the new lows list. What are the stocks in an uptrend that are no longer going up? And so in this case, I'm looking for NYSE stocks making essentially a new 52-week low. And again, not that I would automatically sell these or be negative on them, but I like to see what is not agreeing with the overall trend in the market. And that's, again, a starting point to see what's acting differently. And it'll help open up your mind to the fact that not everything is going up in a bull market and not everything is going down in a bear market. The final thing I would say is change the visualization. So, a consistent technical approach is very important. However, if we get too wedded to one way of looking at things, I find it's like putting blinders on. You eliminate the possibility of opening up. And that's why going to conferences like ChartCon are so helpful, because it helps to break you out of your routine. In this case, I've inverted the chart of Apple, and I actually learned this. I don't know if many of you know, but if you just put the minus sign before a ticker, it allows you to invert the chart. Very easy to do, and it just kind of reorients you to a new way of looking at it. So, Apple overall has been in a great uptrend. If I flip the chart over, is this the type of chart I might want to buy if this was a stock? And if so, boy, that might make me want to revisit the fact that Apple is a good long here. Not necessarily saying that, but I'm thinking for many of you, you probably have not done that. Flip a chart over just to, break yourself of the biases of knowing the chart of Apple so well, or whatever stock you trade. And see if you would have a different opinion if you flip it over. So those are three quick ways you can try and combat the impacts of recency bias. As I mentioned in the introduction, I'm really excited to start writing a full blog for stockcharts.com called The Mindful Investor. These are the types of themes we'll hopefully pick up on, looking at behavioral biases that impact your decisions. And what I like to do is focus on practical tools that are going to help you minimize the impacts of those biases on your decisions, and hopefully help you revisit your own investing and relationship with past, present, and future. So with that, I really appreciate it, Tom and Erin. Pleasure to be with you as always, and I hope this was helpful.
Hey, Dave, I got a question.
Yeah. So
if I am in a losing trade and I flip the chart, does that mean that I'm now in a winning trade?
This could be an optimistic, fun thing to do when your positions are really going against you, Tom. I think that's probably true. It's funny, though. This is something I've done with institutional investors for years, which is take some of your best ideas and flip them over. And it's so funny how often you recognize that you just were, you thought of the chart of Apple and you're thinking of the products and not what the chart is telling you very plainly. And just by tweaking it a little bit, you find that you break out of that and realize, yeah, it might not be the best idea here.
Absolutely. Well, I think we had a question in the room. So, Erin, you want to start with that?
Indeed. First of all, does your system work with all markets? And second, do you look at high beta stocks or more popular stocks?
Great questions. So, in general, I like to look at technical analysis as representing the underlying behavior of investors. So the tools that I use are all tools that I found over my career are good representations of fear and greed, and they're manifestations of that. So having said that, any market that is driven by those emotions and by emotional buy and selling of investors, I think it's absolutely worthy of. And I would say now it tends to be the most effective, arguably, on things like emerging markets, frontier markets, lesser known things, because that's where there is less transparency. There's more opportunities for emotional decisions to create volatility and create opportunities. Having said that, the only thing that I find these techniques are less effective on are things that are not driven by emotional buying and selling. So something like economic data, or something that may not, it's representing some sort of supply and demand that might not make sense with an emotional decision. That's where I've tended to stay away. But what I've described using ETFs, that's most things in the market that you could apply these sort of tools to. And then the other question on high beta names or popular names. Yeah, I mean, I think one of the good things about the techniques that we've talked about here is they're meant to be applied across securities, across different types of stocks and different types of names. So anything that moves and has the volatility that stocks tend to do, especially in the U.S., I think it's worthwhile doing it. And I think you will find that that stocks with different volatilities, techniques like moving averages and RSI, kind of naturally adjust to the price of the instrument. So I think it's valuable looking at something like a utility, just like I would look at it at a higher beta space, like a technology or some consumer names.
A follow-up question there with the high beta stocks. How do you look at, say, these cannabis stocks right now? I mean, clearly they're uptrending, but the slope of the uptrend is not sustainable. So what do you do? I mean, you got a good group, a solid group, clearly outperforming the market by a wide margin, but you know, trees don't grow to the sky. So what do you do with a group like that?
So yeah, that's a really good question, and I would say with the cannabis stocks, you know, my first reaction to a couple things. One is with anything like that, especially something that's newer to trading or becoming more liquid over time. I think you have to be a little careful about some of these techniques, right? If I'm looking at the 50 and 200-day moving average, the more data I have, the more valuable that becomes because it starts to track the price and it starts to track the underlying emotions that are causing investment decisions. So with some of the cannabis stocks, they're a little less liquid and are so recently traded or recently new that I don't know if there's enough data necessarily with something like moving averages to really capture it yet, especially longer term moving averages. Having said that, I think you need to bump down the time frame and understand that, you know, it's hard to make a decision about months ahead of time if you only have a month of data, right? So with some of those, I think especially, you know, something like RSI, looking at overbought, oversold levels, that's what I would probably rely on the most because you're in uncharted territory with some of these stocks that are at, you know, going to all-time highs very quickly, similar to what you saw with Bitcoin. I think it took a while for Bitcoin to sort of settle down into a framework that we understood technically. How do you track this? But once it sort of, you know, hit the high in the 20,000-ish and then came down into there, all of a sudden you have support and resistance levels to pay attention to. You have trends that you can follow. So I think with some of them, it's a little early on. With those of them that have, you know, the more data that you get, I think the more effective of a decision you can make with a lot of the charting tools we have.
Okay, fair enough. Why don't we pull up that poll? Because I think that was pretty interesting. You know, you had a couple questions in there, and I think it fits right in with your discussion today. So if we can get that poll up and take a look at some of the percentages here for each, maybe do you have some comments looking at that, Dave?
You know, very interesting. I was wondering what the results would be, and two things that strike me. Number one, look how much some of us have struggled with each one of these, and that's exactly what I found. I have found working with investors over my career that people tend to do one or two of those very well, and they tend to do one or two of those, you know, relatively speaking, a little less well. And I think that, you know, having an awareness of your own weaknesses and your own opportunities for growth, I think is fantastic as a trader or as an investor, because that's the upside for your own practice. It's funny also that most of us, the majority or the plurality is with living for the present, which is something that, you know, mindfulness training was really designed for people to do more of, because it's very easy to get caught up with a bad trade, especially when you have a bad streak as a trader, as both of you probably can attest to. Boy, it's really hard to dig out of that mentally and just, you know, focus on what you're seeing now. And the same thing, you know, it's way too often that we make a decision without a good plan for the future. So I think living for the present and having a good sense of what's happening around us. The good news is charts are probably the best tool I've found to give you that awareness. And yeah, this is great material for me to think about as I start to write the blog Mindful Investor and think about how I can help each of us kind of focus on each of these. So thanks so much, everyone, for responding.
Yeah, that was an excellent presentation, and I agree. I mean, the fact that these three are so close together, it's like everyone is kind of struggling with a little bit different, you know, little different demons, you know, whether it's the past demons, the future demons, or trying to live, you know, for the present. But great discussion. I knew everybody would enjoy this because it was such a great presentation at ChartCon. And it's always a pleasure to have you on here, Dave. Look forward to having you back soon.
Cheers, guys. Thanks so much. Have a great day, all right?
Absolutely. You too.
You do the same. Yeah, that was, I took a course. I'm trying to think of the name of it. I think I've mentioned it on the show before. The heck was it called? Mind Over Money, I think was the name of it. And it was probably 11 or 12 years ago. And it's amazing how, different people, depending on, things that they've learned from, sometimes even from your youth, how that affects your mental state when you're trading stocks, and how you relate to making money or losing money, and how you can learn from those mistakes. And sometimes you have troubles learning from mistakes just because of certain things that have happened in your past. But I thought the timing and all of this is great, and I look forward to having Dave on much more often so that we can continue to consider this in our trading, because I think it is really huge.
Yes, you can't let your ego get in the way. I know that's part of the problem with learning from the past for a lot of us. You don't want to admit to those mistakes you made.
Yeah, actually, that was one of the things they said in the course, is that one of the biggest problems with the human psyche is that when you take a loss, when you think about it from a financial standpoint, when you take a loss, you're admitting you made a mistake. And we don't like to admit we make mistakes. We like to think that we're always going to be right. And so part of that is that we want to hold on to these stocks that are losing money and not making money, because once you sell, you've admitted failure. And from trading in the stock market for a long time, believe me, just accept the failure and move on pretty quickly.
Exactly.
Because the failure gets worse. It gets more expensive as you hold longer.
It's absolutely true. All right, so let's race ourselves through the 10 and 10. We've got quite a few requests I'm going to just show very quickly, because what I found interesting today, this is the RRG that I looked at, and I'll be looking for those stocks going in that northeast direction. But I don't only pick those. I mean, I don't do that. But what I found was interesting is when I scroll down here, because we do this every day, 3 technology requests. That was it. And we had I think we had about 37 requests here, and only 3 were technology. That is just a first here, I know.
Yeah, that is kind of crazy.
Isn't that weird? So anyway, healthcare seems to be part of the interest, of course, cannabis being in the middle of that. So anyway, let's go ahead and get started. And our first one is Fitbit. And I do wear one. I like it, but it thinks that I'm dead most of the time because I don't go anywhere.
That's not good. Why are you wearing it if you're not going anywhere?
I know, it just reminds me of what a slug I am. I don't know.
All right. Well, here is Fitbit. Here's a look at the chart. And the chart has been a little bit of a slug, as you can see. I mean, we were moving lower back in 2016 into early 2017. Went sideways for a while. And I'll be honest, looked like a change of character back in early June when we took the break, made this breakout, went above gap resistance, the price resistance. We had tested the 7.25 area a couple of times. And then finally we made the breakout. Look at the volume coming in. I mean, it looked like we had the real deal. And then the breakout didn't hold. And we proceeded to lose, I don't know, probably 25, 30% over the next 2 months. And so I think the stock is just kind of lost here. I don't see any reason, I think what Dave was just talking about. I mean, do you see an uptrend or a downtrend or anything going on here? I mean, we had a short-term downtrend, which was broken. But I think when you look at this over the last year and a half, 2 years, you see a stock that really just can't seem to make up its mind which way it wants to go. So as a momentum trader and as a trend follower, I would avoid Fitbit. I just don't see anything. I think, if this was a stock that was trading much, much higher a few years ago. So if we can get back up above, say, that 7.75 area, start getting above 8, the volume comes in, moving averages follow suit to the upside, then I think maybe we have something to trade. But I'm going to wait and let others take their shot on this one and see which way it goes, because based on what I'm looking at, I really just don't see anything worthwhile.
All righty. Let's see, the most popular in the chat room, and we do this because I don't repeat for a week on our symbols. Square, which we did look at this week, but because everybody wants to look at it again, let's go ahead and look at it.
Yeah, Square, I think, looks pretty good. I mean, this is in that financial administration space, which has been a very strong group. So from a relative strength standpoint, this is a group, this is the type of group that I would want to be involved in. Now, when you look at Square, I don't know. We did go down earlier to about $84 back earlier in September. Seems like we're testing that level again right now. The PPO is a little suspect on the last push to the upside. You can see that the PPO looks like maybe it was just starting to roll over. If we can hold the 20-day, I think we have one more shot back to the top side at 92.50. But we're going to have to deal with a declining PPO if and when we get there. So I've got a mixed picture here. I'm a little nervous about some of the higher PE stocks in the market right now, just being in this second half of September and seeing the NASDAQ Russell 2000 underperform a little bit here. So I'm a little nervous and playing things much more cautious than I normally would. But I would just say, strictly looking at this chart, ignoring everything around us, if we can reverse and hold the 20-day moving average, I think we got another shot at 92.5. If we fail to hold, though, I think we could potentially go all the way back down close to the 50-day. So I would watch and see how we close the day on Square.
All right. The next one I have for you, and let's see, Lululemon. Is it a Lulu?
Yeah, I think it's consolidated in a nice little flag off of a move to the upside on heavy volume. We saw this continue on, this sideways consolidation continue on once before back here when we gapped up with earnings. And then we kind of got stuck in this range here for, I don't know, the next 3 months or so before finally breaking out, having another solid report with earnings. But that volume on the last two earnings reports, I think there's some accumulation taking place. And with everybody getting in, market makers, of course, on the other side. So I think it's taking some time to consolidate. But I would be a buyer if Lulu hit the 20-day moving average, because you got both price support and the 20-day at about 150. And I could keep a really tight stop there. If it breaks down, starts to head back toward gap support, I could get out on the breakdown. So I like it as it gets closer to 150.
All right. Let's see the next one. It's a juiced ETF, but this person's been very persistent about requesting it. So I'm going to go ahead and put it in there. BRZU. It's the Brazil Bull Fund 3 times.
Yeah, well, I mean, it's been in a downtrend for a while. So the problem is that when you've got a juiced ETF and it's going in the wrong direction, you're losing your money 3 times as fast, which I don't like. So I tend to stay away from juiced ETFs simply because at least I don't hold them. Let me be clear. I don't like to hold them. I'm going to go back a little further here on this chart. Let's go back over the last couple of years and take a look. I mean, you're definitely counting on a reversal off of a downtrend if you're playing this on the long side. And I don't like to play downtrending stocks, period. So I certainly don't want to risk triple the amount by playing something that's been in a downtrend for quite some time. Yes, you might be catching the bottom. And I would just say this, if you are catching the bottom, you should begin to trade above that 20-day moving average like we did for a little bit in July. But if it falls apart back to the downside, I would be really careful. The other thing I'll say about these juiced ETFs, even though I am analyzing it on the chart, I would prefer to go back to the underlying index and look at that in terms of technical indications, because these juiced ETFs erode over time, especially if it's a volatile ETF or a volatile underlying index. So sometimes you get signals on the juiced ETF that are not the same as the underlying index. So I always want to follow what's going on the underlying index. But I can tell from the action, this has been a very, very weak area of the world. And I would not be a fan of being a 3-time bull, personally.
All right. How about a materials sector stock, Cliffs Natural Resources, CLF?
I didn't annotate anything on that chart, but I just quickly showed the downtrend. I would stay away from it simply because of that downtrend. All right, CLF.
Mm-hmm.
Yeah, I think CLF actually is on my strong earnings chart list. And yeah, it continues to trade very well. It's up against some pretty significant longer-term resistance, and it's possibly reversing with today's candle. So this is an area you want to be careful. And this is textbook, exactly what Dave Keller was talking about during his presentation, as he showed you with Starbucks. The problem is when you get to a key area where sellers have been in the past, I think you should expect that sellers are going to be there again. So in the short term, I think we're going to likely see a pullback on CLF, but I think this uptrend is likely to eventually give us that breakout, and that's what I'd be looking for. But I'd be a seller here in the near term and perhaps a buyer as you get back closer to the recent breakout. That should provide us some support now. And notice that's also just about where that rising 20-day moving average is. So I like CLF. I just think in the near term, we could see a trading range down closer to $11 to the downside and maybe around $12.50 topside.
All right. Let's see the next one up. Ring Central Computer Services, RNG.
Yeah, I'm going to shorten it back to this. You can see on this 2-year chart, though, it's a very nice uptrend that's been in play for quite some time. I still believe that this is a stock that continues to move higher. The problem right now is you've got a negative divergence, so I think we could see a 50-day test, which almost coincides with the recent lows that we've had. So I'd be watching maybe for 83 to 85 in this area to hold. We could probably draw a trend line that's very close to that level as well. But here was your higher price. Here is your lower PPO, and check out the volume. It's gone. So you've got slowing momentum in terms of volume. You've got slowing price momentum in terms of the PPO declining while price is going higher. Then we lose the 20-day moving average for the first time during the last 6-7 weeks, and I think that's going to lead to more weakness. I'd be watching right around $84, $85. I think we might get a reversal there.
All right. Let's see. Next one, 3M Company, MMM.
I wonder how they came up with that ticker symbol. Yeah, it's starting to strengthen a little bit. The Dow is almost ready to break out above the January high. So part of the problem is that this is going to be one of the relatively weak stocks in the Dow. And so Dow's outperforming currently, but you don't have one of the stronger stocks here. So what that tells me is if I'm going to get involved in the stock, I want to watch a couple of things. First of all, pretty big level here. Gap resistance is right at about the 213 area. We're trying to get through. Not a lot of volume, though, at this point. So I'm thinking maybe even this reaction high. See that prior low in February? We broke down below, reaction high, trying to get through 218. I think this is going to be an important zone for 3M. So if we can't get through and we start to turn back lower, I'd be out of it. I don't like the relative weakness and the underperformance over the past several months, and the volume trends outside of maybe this one day, which appears maybe to be an exhaustive gap down. We tested that prior low, heavy volume. So it looks like maybe we've carved out a bottom, but I think a move through 218, 219 would confirm it.
All right. Next one was a popular request, Kronos Group, CRON. Of course, the biotech shooting through the roof.
Yes, it is. I think they might, aren't they in the cannabis space as well?
I bet.
Thinking they are, but don't quote me on that. Anyways, CRON, you can see big breakout, or at least the attempt of a breakout here. It certainly has moved like cannabis over the past several weeks, or 3, 4, 5 weeks. But the huge move up here from $5 and change to over 15 today, I think we could use some settling down. The volume is extremely heavy. If we do get the breakout on the close, then I think in the near term, we could see a little bit more strength. But if we fail, if we leave this long tail up here to 1530 and close back down below, say 1340 or 1350, whatever this high candle body was, then I think it sets up for more consolidation. Perhaps these higher lows would be some sort of an ascending triangle with the equal candle bodies coming across. So those are a couple of things I'd look for here. But this is a wild stock, very volatile, and you got to have a strong stomach to trade it.
All right. Our only consumer staples request, and it is in the soft drink space. So I have to wonder if this is another cannabis related move, but Reed's, REED is the symbol.
Yeah, I'm not familiar with this stock, and obviously, except for it could be because the volume really picked up again in August when there's been a lot of recent action in this group. But when the Fuhrer is not here and you don't have all the folks rushing into to this particular stock, you can see volume tends to be very, very light. So you got to be careful, especially on this stock, because if the volume that's supporting this move to the upside all of a sudden disappears, then you could be stuck with a stock that's not too easy to get out of in terms of liquidity. So we got a false breakout so far today. I think the stock from a support area, I'm going to say $2.85 to $3 right in this zone would be a key support level, but I would avoid it simply because lack of liquidity.
All right. And finally, our final stock is in the energy sector. Hornbeck Offshore, HOS. Another low volume one, but worth a look, I think.
Yeah, it's trying to get back through some key resistance. I would say I'm not interested in the stock, by the way, but let's just take a look and see what is going on. First, we could draw a line. I mean, you could, depending on how you want to draw a trend line, you could say, okay, we're breaking the trend line, but we've done this before. I could start with the tails and say, okay, I haven't yet gotten up here to break the trend line. So it just depends on how you want to draw these lines. What's more important to me, even if you try to make the argument, okay, I've broken this trend line, well, I would just argue, well, you haven't broken price resistance. And to me, that's more important than the trend line, because trend line is pretty subjective. Price support, I can get to the penny. Price support and resistance. You can see multiple tests here now trying to get through about 465. We were up there yesterday and backed off. I don't like the stock as long as it stays below about 465. If the volume comes in and we get through 465, I'd like it better. But as you mentioned, Erin, it's a pretty illiquid stock. That alone would keep me out of the stock. So I'm going to pass.
All right. And that completes the 10 and 10. Believe it or not, that went pretty quick. Good job, Tom.
No, we were a little behind, but
yeah, here we go. So there are the symbols for you. I will have these up in the Market Watchers Live chart list, and you can find that if you go to the blogs tab and click on the Market Watchers Live blog, and there you will get the link to all of these charts. All right, time for our final market update. Let's go ahead and see what has been going on while we've had this interesting discussion. All right, markets are still up, but a little bit bifurcated right now. As you can see, the Dow has reached intraday highs, seems to be consolidating sideways on those intraday highs, currently up 202.72. You can see the S&P 500 is also moving higher, but seems to be in a little bit of a sideways channel here, trading range. We'll have to see if it can get back up toward the top of it. And notice that the NASDAQ is lower right now on the day. Certainly technology not keeping up with some of the other indexes at this point. S&P 100 is up. We can see mid caps and small caps also having a difficult day, with the Russell 2000 moving past the intraday lows back from Monday. We can see that the TSX is mostly unchanged, but up 5.32. And we've got the treasury yields there. Actually, they did hit an intraday high. They are coming down just a little bit, but still reading well over 3% at 3.068%. UUP has it started the day up, but it has moved its way down. Looks like it's hit the intraday low at support level of 2506. It looks like it might be heading back up here. We'll have to watch and see. But gold is having a great day, big gap up, and really is continuing to trend higher. Currently, GLD is at 113.90. TLT is lower on the day. It is making up some of the losses that it had this morning, but still down. 116.83 is your TLT reading. And finally, USO is higher by 1.21%. So we're seeing oil prices rising steadily here after the low we had back on Monday. And that concludes the final market update. What do you have for us, Tom? And then we can move on into our next segment.
Okay, well, I thought I would just show a 3-month, 60-minute chart of the NASDAQ, because I do think that we've got some issues here. And we are in the second half of September. I've mentioned this plenty of times. Seems like money is rotating a little bit more toward the safer Dow and S&P 500. And we're seeing relative weakness now on the NASDAQ and the Russell 2000. So when I look at the NASDAQ's chart here over the last 3 months, you can see that we're putting in this series of higher highs and higher lows. And right now we're just kind of meandering here sideways. But we have been down on multiple occasions now, just a little bit below this 7,900. Let's call it 78.75 to 7,900. We're currently sitting at 79.29. I would just be careful if we lose that 78.75 level, because the next major test, in my opinion, wouldn't come in until we get down to about 77.40, maybe 77.30, something like that, which would be another 140 points, almost 2% further. I still love the market going into the fourth quarter. I just think in the short term, I've gotten much more defensive here as we go through the balance of September, just waiting to see if we get some cheaper prices. I do think we'll get a run up into earnings season. That's typical what the market does, and I think we'll get it again. But in the short term, just watch this level really closely around 78.75 on the NASDAQ.
All right. Well, let's get started on Are You Buying This? And this segment is about presenting a possible buying opportunity to each other and then determining whether they would buy it as well. So I'm going to start off here. Let's see. I am going to start with RIG, Transocean Incorporated. I really like this chart. I think there's some great upside potential here. And here are the reasons why I think that. First of all, we have a beautiful double bottom pattern off of this decline at that top back in July. We came down into the pattern as you're supposed to and set up two bottoms right next to each other. You can also see that the PMO bottoms were rising at that time while these were mostly flat. So that is good news as well. And today we are now executing and confirming this double bottom pattern. Given the height of the pattern and added to the breakout point, I see prices going right back up to that high we had in July. I think RIG looks awesome. What do you think?
Well, I tell you, this is a segment that highlights our differences.
Yes.
Our differences in strategy, that's all. Yeah, RIG, I think in the short term, first of all, it's been up 6 or 7 straight days. And when you look at the long-term chart, I'm just going back the last couple of years, it's one that really hasn't participated with the market's move to the upside. So I have some problems just because longer term, it'll certainly go through periods, but it seems like the strength never lasts and eventually just turns back around. Now, I would just, I kind of buy it in the sense that the volume is nice today. We're getting back above that recent high. We're getting through the 50-day moving average. I would just not buy it in the sense that I'd have a really tight leash on this thing because it has had so many failures. And if you look at the tops almost exclusively, I'm going to shorten this back down quite a bit so that we can really take a look at the last few tops. When this stock tops out, take a look at these candles with the long tails to the top almost every time. So that's what I would be careful about today. If we happened to finish weak today and leave a long tail above this prior high, then I would probably be a little bit more suspect in terms of whether or not I would be into this stock. The other thing is volume trends have definitely picked up. We did have some selling that took place in early September, but we did hold support, as you mentioned, and we have rallied back up trying to get through this level. But there's so many levels on this chart. So I can buy it, but I would keep a very tight stop because of its history of reversing off of what appears to be breakouts and not, I mean, this one was a perfect example back in July where it easily had cleared that prior May high and then completely just fell apart. So it's a tepid, I'm buying it with a stop in place. Is that an answer? Am I allowed to give that answer?
I think so. Oh, of course you're allowed to give that answer because then I can give that answer.
All right. Well, I am going to give you a chart here. And this is a long-term, this is 10 years on the XLF relative to the S&P 500. And back in November of 2016, we made what I think was a very significant breakout in terms of relative strength. Now, I don't normally think of financials as being the group to lead the S&P to the upside. I just really want the financials going along for the ride. I mean, you've got key groups like banks. You don't want banks underperforming. They're so vital to our economy, especially with all the debt that we like to take on as American companies. So we want to make sure that the financial group is healthy. Now, we have been underperforming versus the S&P 500 throughout most of this year. And the 10-year Treasury yield has been moving higher, especially recently, breaking out, as you just mentioned in your market update, getting close to a 7-year high. Now, when you look down here at the bottom of this chart, this is a correlation of the direction of the 10-year Treasury yield and the direction of the XLF versus the S&P 500. So it's these two charts that we're looking at. And the correlation, when you look at it here, is pretty darn positive most of the time. Yes, we do venture down negative territory from time to time, but if you look across the top, see how many times we get close to a 1, meaning that they are going hand in hand. We hardly ever even get past minus 0.75, and those trips tend to be very short-lived. We were just down there, and I believe that the financials relative to the S&P 500 are going to begin to outperform, to move up along with the 10-year Treasury yield, which I expect is going to break out above that 3.11%. So I'm going to say that the financials in the fourth quarter of this year are better performers than the S&P 500 in general. Are you buying that?
You know, if we're looking at it as being tied to the Treasury yield, which, you know, looking at that chart, you can see that it really does travel, like you were saying, with correlation that's similar, you know, in that direction. I've been calling for a huge decline in bonds. I wrote about it yesterday. And of course, you know, bonds going down, generally you're going to see the yields moving higher. So I have to say, I agree with you. I'm buying it. I think financials are going to start to perk up here. And we really do, I agree, need them to start perking up. So I'm buying it.
Yeah, this thing is really perking up today. As you can see, the XLF has really strong data today, up about 1.75%. That's why I wanted to go over it, because I do think this could be character change given the strength in the 10-year Treasury yield.
All right. Okay, I'm going to continue down the stock rabbit hole here. And I have quite a few, but I am going to go with, let's see, I wanted to look at AES. All right, I'm seeing this cup and handle starting up here for AES Corp. And if you want to know more about what these are, you can click on full quote. And that gives you the information you need. Conventional electricity. I actually am a pretty big fan of utilities and have been. And I really like the setup for AES right now. You have a strong stock. It's been in the scooter hot zone, as I call it, since, wow, back in mid-April all the way up. Look at the PMO. It got nicely oversold above the zero line. You can see it hasn't even gone below the zero line in the last 6 months. And it's, you know, reached that oversold level. It's moving its way back up. You can see volume on the OBV. It's now started to beat out the previous tops. I'm thinking this looks pretty good, and I like that pullback on this possible handle on a cup, pulling back right to that support level here. And I would look for it to go up at least to test the top of this, the top here where we have the overhead resistance at about, looks like 1425. This one's interesting. What do you think?
All right. I actually, I think I like this one.
Hey!
Yeah. I think this one looks pretty good. I pulled it up on a weekly chart, so I'll show you that. Yeah, the daily chart was kind of gyrating back and forth, so I wanted to kind of get a look at a bigger picture. And what I see here, number one, and I don't know, I mean, it has made a move. It's almost doubled here in the last couple of years, but I do think that the tendency, maybe we should go back out a little further. Maybe I'm wrong. I think the tendency is that we don't get a whole lot of movement in this stock. Yeah, I mean, you can see it just kind of trends sideways, but we did make a long-term breakout, which I think is very bullish. And then here's the weekly chart. You can see this movement to the upside here, the trend that we're on. That pullback, that weakness that you were showing in the daily chart actually came down beautifully and tested that rising 20-week moving average, and also came down and basically tested the breakout level and is starting to turn back up. So I think this one looks good. I think longer term, I expect AES to make a breakout. The only thing I would say about it is that looking back over the last 9 years of this bull market, it's not one that tends to move. You know, you're not going to look at the stock in a couple of years and see a $25 or $30 stock. I don't believe. I think this will be a much slower mover, but I do like the setup in it. I think it goes higher. So I'm going to
All right.
All right. And we're going to do one more really fast.
Okay.
I'm going to go ahead and take NVIDIA. And my point here is, I'm not giving up on the semiconductors. I think we're going to rally into the fourth quarter in the semi group. I just think the market's going to do well. And semis so far are holding on to support. And while we've been seeing the semi struggle, check out NVIDIA breaking out with pretty heavy volume in the second half of August, going back down, testing their breakout level. And when we look at a relative chart, you can see NVIDIA relative to semis doing extremely well. Just 2 weeks ago, we were breaking out to a new high relative to the S&P. I think NVIDIA is a good stock within the semi space. If you want to get involved, I think this is one to trade. What do you think? You buying it?
All right. Let me pull it up on my scale here, because I need to know what's going on with the PMO, and see the PMO is on a sell signal. I agree with you. It's a strong stock, but it is in a weak sector and or industry group. I just don't see it perking up that much. I mean, look at what happened today in the market with the NASDAQ. It's still going lower, even though we're seeing some strength in the Dow and the S&P 500. We do have a stock, though, like you said, I agree. It's a good stock. Look at this scooter. It's been spending a lot of time above 70. And even when it goes below, it never gets much below that 50 reading. So I like that. But, look at my OBV. It's confirming this downtrend with the tops. And even on your investment strategy, we're looking at a breakdown below that 20-day EMA. So I have to say, I'm not really interested. I might consider it when we get to that 265 level. That might be where it could get interesting. But, an overbought PMO sell signal, I just can't buy that. I'm sorry.
Okay, that's fair enough. It's okay. You don't have to apologize. We're not going to agree. I know our styles are a little bit different, and that's
Absolutely.
fine. Everybody out there listening's got a different style, and they probably don't agree with me most of the time too, so that's fine.
Yeah, I think the good thing, though, Tom, is that we are true to our styles and our analysis processes. It's kind of a good thing that we don't necessarily talk each other out of our analysis.
Yeah, I don't try to talk you out of yours, and I won't be talked out of mine. So it's fine.
You're just a wee bit stubborn.
I am a little bit stubborn. Well, I've lost a lot of money over the years trying to figure all this out. Still don't have it figured out, but I keep trying.
Oh.
Anyhow, so yeah, but I would keep an eye on the market. I mean, we've got the Dow Jones Industrial Average currently up 189 points, but there is bifurcation out there with the NASDAQ and the Russell 2000 not really following suit. So there's enough to be concerned about right now in the market. I just think in the short term, with the Dow getting close to an all-time high, the S&P not far away, and seeing the big reversal today in the NASDAQ and the Russell 2000, I would be a little careful right now in the market, just in the short term. Again, I'm bullish longer term.
Yep, I have to agree with you. I do think, now that my short-term indicators are starting to get really overbought, that I would be starting to watch for a decline, at least in the short term. But, overall with the market and seeing the Dow doing well is a good thing. I would expect to see more rotation. I think that's really what we're looking at, is rotation into different areas where there is strength. I don't see the market really tanking anytime soon.
And I would love to tell everybody what to do with those cannabis stocks, but really that is like a roller coaster ride. So
yeah, it's out of me. I don't do that.
Yeah, if you can figure that one out. Anyhow, thanks to everybody for being with us today. Again, a shout out to Dave Keller for coming on. Loved his presentation today. Again, thanks, Dave. Remember to complete that survey when you exit, if you don't mind. We love to get your feedback. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays, noon to 1:30 p.m. Have a great Wednesday afternoon, everybody. We'll see you back here tomorrow. Happy trading.